Every American economic debate today is about inflation or recession. We are asking the wrong questions. The real threat isn't in the next business cycle. It is contained within a single, terrifying chart that has already predicted 35 years of economic stagnation once before, and is now flashing red for the United States. The statistical mirror is unnerving. In 1990, at the absolute zenith of its bubble, Japan's Nikkei 225 stock index traded at a price-to-book ratio of 5.5. In 2021, the U.S. S&P 500's P/B ratio hit 4.7, a level not seen since the dot-com peak. In 1990, the value of Japanese commercial real estate was famously estimated at 4 times the value of all U.S. real estate. In 2022, U.S. commercial real estate crested a $20 trillion valuation, propelled by a decades-long debt-fueled boom in asset prices. We interpret these metrics as signs of American dynamism and strength. In Tokyo in 1990, they saw them as proof of a new paradigm, too, an unassailable economic model. Then the bubble popped. The new paradigm shifted overnight to permanent disinflation, near-zero growth, and a forest of debt-laden zombie companies kept alive by perpetually low interest rates. This raises the most critical, heretical question. What if the great inflation scare of 2021-2023 was merely the last feverish gasp of an old, dying economic system? What if the true, lasting legacy of COVID-era stimulus and financial engineering is not runaway consumer prices, but the precise structural conditions that trapped Japan in economic purgatory for an entire generation? To diagnose America's potential future, we must first perform a full autopsy on Japan's incurable and ongoing economic disease. Japan's crisis was not a typical recession, it was a balance sheet recession, a term coined by economist Richard Koo. This is the core disease, not a symptom. After a massive asset bubble bursts, the collective psychology of the private sector, corporations, and households undergoes a fundamental shift. The goal is no longer maximizing profits, but minimizing debt to repair shattered balance sheets. This happens regardless of how low interest rates fall. The Japanese case, verified by BOJ data and Koo's analysis, is definitive. After the 1991 crash, Japanese corporations stopped borrowing for investment, even as the Bank of Japan cut rates to zero. For 15 consecutive years, they used operating cash flow not to expand, but to relentlessly pay down debt. Aggregate private demand simply vanished. In this environment, monetary policy, trying to stimulate borrowing, became utterly ineffective, like pushing on a string. The critical policy error was misdiagnosis. Japanese authorities initially treated the collapse as a normal cyclical downturn, applying timid fiscal stimulus. Koo's framework argues the only correct prescription was immediate, massive, and sustained government deficit spending, running fiscal deficits to replace the missing private demand until the private sector completed its deleveraging. Japan eventually did this, but too hesitantly and too late, prolonging the agony. The outcome was not a sharp depression, but a lost decade's stagnation. Nominal GDP in 2020 was barely higher than in 1995. Prices gently but persistently deflated. The Nikkei stock index never reclaimed even half of its 1989 peak. This is the defining feature, a long, slow debt deflationary grind where economic vitality slowly leaks out of the system. For 3 decades, American economists dismissed this as a uniquely Japanese failure, a cautionary tale that couldn't happen in the dynamic U.S. economy. But 3 seismic shifts in the 2020s have constructed the precise identical trap on American soil, setting the stage for a domestic balance sheet recession. The United States is not merely flirting with Japanese-style stagnation. It has converged on the 3 structural flaws that defined Japan's trap. Parallel 1, the debt supercycle peaks. The U.S. total debt-to-GDP ratio, encompassing households, corporations, and government, now sits near 350%, dwarfing Japan's pre-1991 peak of roughly 250%. Crucially, this debt is mature. Future economic growth must be diverted to service this existing burden, not to finance new, productive investment. The debt itself becomes a drag on expansion. Parallel 2, the demographic inversion. Japan grew old before it became wealthy. America is aging after accumulating historic debt. The U.S. old age dependency ratio, retirees to working age adults, is on track to reach Japan's 1990 level by 2035. Aging populations naturally save more and spend less, creating a chronic structural shortfall in aggregate demand. This is the core of what economist Larry Summers termed secular stagnation. Parallel 3, the exhaustion of monetary policy. The Federal Reserve's balance sheet remains bloated at over $7 trillion. Like the Bank of Japan, whose assets exceed the country's entire GDP, the Fed's ability to credibly stimulate with massive new rate cuts or quantitative easing in the next crisis is severely diminished. The monetary ammunition box is nearly empty, just as Japan's was in the 1990s. This combination is lethal. Extreme debt plus a rapidly aging society plus an impotent central bank, an economy with zero margin for error. One significant shock, a commercial real estate bust, a shadow banking crisis, could be sufficient to flip the U.S. private sector's psychology from profit-seeking to debt repair mode. The documented narrative of American exceptionalism, dynamic and innovative, collapses against these verified structural vulnerabilities. The switch, in fact, has already begun. You can see it in the most unexpected place: the gleaming, cash-rich balance sheets of Silicon Valley's titans. The Federal Reserve's inflation fight has inadvertently triggered the first silent phase of a potential balance sheet recession, a corporate profitability recession. The data shows American companies are shifting decisively from offense to defense. The evidence is clear. S&P 500 share buybacks, the hallmark of the 2010s boom, peaked in 2022 and are now in decline. Capital expenditure growth has stalled. Most critically, the Federal Reserve AS own survey shows banks tightening standards for business loans at a rate last seen during the 2008 financial crisis. This triple threat signals the early corporate pivot towards preservation, not expansion. The mechanism is straightforward. Rising interest rates didn't just cool consumer demand, they exposed over-leveraged business models and zombie companies surviving on cheap debt. As profit margins get squeezed between slowing revenue and higher financing costs, the corporate priority silently shifts from growth at any cost to shoring up cash flow and repairing balance sheets. This collective retreat reduces aggregate investment and hiring, the initial spark in a deflationary cycle. The 2023-2024 tech layoffs are the canonical case study. Meta, Amazon, and Google didn't announce temporary furloughs. They executed deep structural cuts to headcount and projects in the name of efficiency and durable profitability. This is not a cyclical adjustment. It is the American corporate version of what Japanese firms did in the 1990s, using cash flow not for new ventures, but to fortify their financial foundations against a perceived enduring storm. This creates a profound peril for the Fed. It needs an economic slowdown to curb inflation. But in an economy saturated with corporate, household, and government debt, there is no safe, soft landing. The intended slowdown risks flipping the very switch it seeks to avoid, activating a widespread, self-perpetuating corporate mindset of debt minimization and retrenchment. They are attempting to land an aircraft whose engines, the corporate sector, are beginning to seize up. Therefore, 2024-2025 may not manifest as a classic deep recession with mass unemployment. It will likely be a profitability recession, characterized by stagnant GDP, eroding corporate margins, gently falling asset prices, and a disinflation that slowly, insidiously, hardens into entrenched deflationary expectations. And once those expectations take root, they activate the most powerful deflationary force of all, the altered psychology of the consumer. Once initiated, deflationary psychology becomes a self-fulfilling prophecy, creating a trap from which escape is extraordinarily difficult. Japan's experience provides the blueprint. By the late 1990s, Japanese consumers consistently expected prices to fall. This simple expectation is catastrophic. Why purchase a car or appliance today if it will be cheaper in 6 months? This perpetually delays consumption, crushing aggregate demand and ensuring prices continue their downward drift, exactly as BOJ surveys documented for over a decade. The U.S. is nearing its own tipping point. If core inflation sustains a level below 2% for 12-18 months, a plausible scenario for 2024-2025, the media and public narrative will pivot decisively from inflation crisis to deflation risk. In this environment, workers will accept smaller wage increases, believing prices are stable or falling. This breaks the modern wage price dynamic permanently to the downside. This activates Irving Fisher's classic debt deflation spiral. Falling prices increase the real burden of fixed debt. Homeowners, corporations, and governments find their liabilities growing in real terms, even as their nominal incomes stagnate. This forces further deleveraging, more saving, less spending, which reduces demand, causing prices to fall further. The Fed cannot stop this spiral with rate cuts if the private sector's sole objective is to pay down debt, not borrow. The final crushing anchor is housing. In Japan, land prices fell for over 20 consecutive years. In the United States, a sustained 10 to 20% national decline in home prices, driven by high mortgage rates and reduced mobility, would catastrophically impair household balance sheets. This wealth destruction would cement deflationary psychology for a generation, as it did in Japan, making recovery politically and economically impossible. The contrast is stark. The documented overwhelming focus of the Fed and Treasury has been on avoiding a 1970s-style inflationary psychology. But their policies now risk triggering the verified and far more dangerous 1990s-style deflationary psychology. Faced with this specter, the Washington playbook will mirror Tokyo's in the 1990s, a cycle of desperation, denial, and ultimately the subsidized creation of economic zombies. Confronted with stagnation, the U.S. policy response is likely to follow Japan's failed playbook in 3 predictable, ineffective phases. Phase 1, fiscal bluster, 2025 to 2027. As growth flatlines, expect grand announcements of transformative infrastructure and stimulus plans. However, in America's deeply divided political landscape, these will be inevitably compromised, too small, implemented too late, and laden with inefficient pork barrel spending. They will fail to provide the massive, sustained demand replacement needed to offset private sector deleveraging, mirroring Japan's timid and delayed fiscal packages of the early 1990s. Phase 2, monetary Hail Mary, 2027-2030. With fiscal policy hamstrung, the Federal Reserve will be forced into a corner. It will cut the federal funds rate back to 0% and restart large-scale quantitative easing. But with private sector demand evaporated and balance sheets in repair mode, this new liquidity will not spur lending or inflation. It will simply pool as excess bank reserves or inflate financial asset bubbles, failing to reach the real economy. This is the exact liquidity trap Japan perfected, where monetary policy becomes utterly impotent. Phase 3. The zombie economy, 2030s. The defining feature of Japan, this lost decades, will become America, this new normal, the proliferation of zombie companies. These are firms that are insolvent, unable to cover debt service with operating profits, but kept alive by banks that refuse to acknowledge losses, forbearance, and near-zero borrowing costs. They clog the economic arteries, suppress productivity by hoarding labor and capital, and stifle the creative destruction essential for renewal. In the U.S., this will manifest as 1. Zombie private equity portfolios, over-leveraged companies unable to exit or grow. 2. Insolvent CRE owners, sustained by extend and pretend loan modifications. 3. Legacy industries, permanently propped up by state subsidies disguised as strategic investment. The critical unlearned lesson from Japan is this: you cannot stimulate your way out of a balance sheet recession with monetary policy alone. Only decisive, debt-financed fiscal policy that directly and continuously replaces missing private demand can work. The U.S. political system, characterized by partisan paralysis and an aversion to perceived deficits during non-crisis periods, is even less capable of delivering this sustained effort than Japan's was in the 1990s. The contrast between documented faith in American policy dynamism and the verified historical precedent of political failure in the face of a slow-motion economic crisis could not be starker. The outcome of this policy failure is not a dramatic collapse. It is a slow, grinding transformation of the very character of the American economy from one of dynamism to one of stagnation. A U.S. lost decade would not be a carbon copy of Japan's, but it would share the core feature, the end of economic dynamism. The period from 2030 to 2040 would be defined not by deep depression, but by a grinding low-flation stagflation. Nominal GDP growth would average a meager 1 and 2%, with inflation oscillating between 0% and 2%, resulting in near zero real growth. The stock market would enter a secular bear range, with the S&P 500 trapped in a wide, frustrating band for over a decade. The social manifestations would be profound. The gigification of everything, stable corporate careers would evaporate, replaced by precarious contract and platform work, permanently suppressing wage growth and benefits. The intergenerational wealth freeze. Housing would cease to be a reliable wealth-building vehicle. Millennials and Gen Z, already burdened by debt, would see the asset inflation of the 2010s vanish, locking in generational inequality. The innovation winter, risk capital would dry up. Venture funding would retreat to incremental, sure bets, ceding global technological leadership in frontier sectors to more daring competitors. Politically, persistent economic disappointment would be combustible. It would fuel intense political extremism, a collapse of trust in institutions, and a shift towards zero-sum. Nationalist policies, a pattern eerily similar to Japan, its own rise of reactionary politics in the United States, accelerating political decay over the past 2 decades. The critical difference is volatility. America's path may be the lost roller coaster, characterized by sharper, more frequent mini-cycles of hope and despair, and greater social unrest, driven by its weaker social safety nets, deeper racial and economic inequalities, and more confrontational political culture than Japan possessed in 1990. This is not mere doom-mongering. It is pattern recognition based on a verified historical precedent that is converging with observable U.S. structural data. And this pattern has a precise name, defined by the economist who accurately diagnosed Japan's fate a generation ago. Richard Kuh's framework provides a universal diagnostic toolkit, the 4 stages of a balance sheet recession. Watching for these stages reveals the potential American path. Stage 1, the asset price collapse. This is the trigger. In Japan, it was the Nikkei and real estate, 1989-1991. For the US, this stage may have begun in 2022 with the sharp repricing of technology stocks and, more critically, the historic collapse in bond prices, which ravaged bank and pension fund balance sheets. Stage 2, the private sector, shift to debt minimization. After the crash, the collective goal changes. Corporations and households stop maximizing profits and start minimizing debt. In the US, early signs include declining share buybacks, stalled capital expenditure, and a rising household savings rate as consumers feel poorer. This stage could define 2024-2027. Stage 3, the liquidity trap and policy ineffectiveness. With the private sector in full deleveraging mode, monetary policy breaks. Interest rates can be cut to zero, but no one wants to borrow. Quantitative easing creates bank reserves, not loans. Inflation remains absent. The US could enter this trap by the late 2020s. Stage 4, the long, slow balance sheet repair. This is the lost decade outcome, a multi-year grind where the private sector slowly repairs its finances, growth is near zero, and deflationary pressure is constant. For America, this could span 2030 to 2045. The theoretical escape hatch per coup is sustained, massive fiscal deficits, 5 or 8% of GDP for a decade or more, directly replacing the missing private demand until balance sheets heal. Coup argues this is the only cure. Yet, in the current U.S. political climate of deficit paranoia and partisan gridlock, such a response is virtually impossible. As Coup himself states, in a balance sheet recession, the economy loses its borrowers. No amount of monetary easing can make an injured bank lend or a traumatized company borrow. The powerful counter-argument remains, America is not Japan. We have different demographics, a culture of dynamism and energy independence. But does this truly make us immune, or merely differently vulnerable? It is time to test that optimism against the specific, converging vulnerabilities. The strongest counter-argument to a deflationary future comes from economists Charles Goodhart and Manoj Pradhan. Their thesis asserts that the end of China's labor surplus and global aging will create permanent labor shortages, driving sustained wage growth and inflation, the opposite of Japan's experience. But 3 factors suggest this optimistic view may fail, especially for the debt-laden U.S. first: automation's deflationary power. Artificial intelligence and advanced robotics represent a seismic, countervailing force not fully priced into the demographic model. They have the potential to massively offset labor scarcity, not by adding workers, but by replacing them or augmenting their output, keeping a powerful lid on wage-driven inflation. Second, debt overhang trumps demographics. An aging population carrying historic levels of mortgage, consumer, and student debt does not behave like a carefree spending cohort. It behaves like a risk-averse saver, prioritizing debt repayment and retirement security over consumption. This debt-induced thrift directly suppresses the aggregate demand needed to create inflationary pressure, potentially overwhelming demographic shifts. Third, the China factor itself. If China, the supposed engine of the coming labor shortage, succumbs to its own severe property and debt crisis, as current data strongly suggests, its economic model would pivot from exporting cheap goods to exporting deflation. A Chinese balance sheet recession would flood the world with excess savings and reduce demand for commodities, crushing the global inflationary thesis at its source. The verdict? Demographics are a slow, deep tide. Debt is a sudden wrecking ball. In the coming collision within the 2030s U.S. economy, the immediate crushing force of debt deflation and private sector retrenchment will likely overwhelm the slow, steady push of demographic inflation. The only black swan hope is a productivity miracle from AI so profound it grows the economic pie faster than the debt burden expands, effectively making the overhang vanish. This is possible, but it is a speculative hope, not a basis for sound policy or prudent investment. The contrast is stark. Documented mainstream optimism focuses on American tech and energy prowess, but verified historical precedent shows that in the face of a systemic balance sheet recession, the overwhelming forces of debt and psychology consistently trump the slow burn of innovation. Hope is not a strategy. For investors, workers, and policymakers, only one approach is rational: preparing for the possibility of a long, lean economic grind. Japan 1991 is not a foreign curiosity. It is the definitive case study in the terminal phase of a debt supercycle. The United States has now entered the same phase. The critical question is no longer if, but how we navigate our own impending lost decades. This demands a resilience framework for a new economic reality. For investors, favor cash flow over speculation, own assets that throw off real dividends, rents, or essential service revenues. In a deflation, government bonds become a valuable appreciating asset. Avoid long-duration growth stocks trading on distant future hopes. They are brutally repriced. For workers, prioritize job security and minimize personal debt. Skills in maintenance, healthcare, elder care, and essential infrastructure will hold their value. The side hustle may become the central economic pillar. For businesses, operational efficiency is king. Margins will face perpetual pressure. Leverage, once a growth engine, becomes a lethal threat to solvency. For policymakers, the hopeful message: learn from Japan's errors. Be preemptive with fiscal support. Recognize the signs of a balance sheet recession early, contraction in private credit demand, and respond with overwhelming, sustained fiscal force to shorten the pain. This requires breaking the political logjam that Japan could not. The final verified insight is this: Richard Koo-Dess model was rejected by mainstream economics in the 1990s because it didn't fit the prevailing models. It was right. It is now the most relevant framework for understanding the West's next 20 years. Therefore, the call to action is to change your metrics. Stop obsessing over monthly CPI prints. Start monitoring private sector credit growth and household debt service ratios. When credit contracts persistently despite low interest rates, the Japanese disease has officially taken hold. The party of debt-financed growth has ended. The morning after in Japan lasted 35 years. America's economic alarm clock is about to go off.